Well, it was this time last week that we were talking about a resurgence in the meme stock rally, these names doubling in a single day. And one of the things that a bunch of them had in common was they had relatively high short positions. And when you have these high short positions, sometimes that's when stocks can actually go the highest because it forces those short sellers to cover their position, meaning they're in the market buying up stocks. Let's bring in Brad Lamensdorf. He's the co-portfolio manager of the Ranger Equity Bear ETF, and Francis Hordelsky still with me on the desk. And Brad, I think last week was a perfect example of some of the dangers of being short, even when you fundamentally don't believe in the businesses. Sometimes momentum can really rip away from you, even if it's, just for a day or two.
Yeah, that's absolutely right. You got to be extremely careful that you're not stepping in front of these momentum stocks and that you're monitoring the amount of short interest relative to the float that are in these companies. And I'd also mention something else. When you borrow a security from your bank, they're charging you interest on that. So traditionally, it's a supply and demand oriented situation. So when you are when you are borrowing and shorting something that's 25% short, traditionally you could be paying 5, 10, 20% interest to the bank just to borrow that security a year. So it's pretty expensive.
It's expensive, and you obviously have to have conviction. And to your point, it can't be too elevated so that it runs away from you. Would you ever short an AMC or GameStop or anything that's called a meme stock?
No, actually, we didn't get really hurt during the first meme craze. We've done this I've done this since 1995. I used to work for the Bass Brothers as well. My partner had worked for David Tice at the Prudent Bear Fund. We have decades of experience between us. And we just know that shorting high short interest stocks is just a very dangerous proposition. So we stay with a little higher liquidity and make sure that our short positions relative to the float, or the shorting relative to the float, is not over, say, 8 to 10%.
The other side of that, Brad, though, is that sometimes the shorts are just wrong. I mean, they can be wrong. I'm not talking about a GameStop or an AMC necessarily, but sometimes the shorts can be wrong. I know they do, and you do your due diligence. You look at the fundamentals and find out what's going on with these companies, but sometimes they can be wrong. So, have you ever taken advantage, and maybe give us an example of a high short interest where you actually did buy, not kind of these quasi-basket case issues?
No, even if we don't like it fundamentally, we will shy away and not get involved with high short interest stocks.
Period.
It's a discipline. We don't like to go there. It saves us a lot of agony. And frankly, we have plenty of names to choose from inside of our research that we do internally that gives us plenty of names outside of these highly shorted stocks. So we just don't really go there. We just find it's a loser's game.
All right, so why don't we talk about this through some examples? What's an idea out there that you are shorting that you think won't cause you same sort of pain and agony as if it's a meme stock?
Right, so we're looking for companies that are creating some kind of accounting pull forward, if you will. So they could be creating some type of discount for their clients where if they signed up for a year, they would give them like a 10% discount. But when they do that, they are pulling forward revenue that's going to have to be replaced at some point going forward. So mergers and acquisitions are a very easy place for them to play these games. So with that being said, we're short the symbol O, the Office REIT, and that REIT had a very large acquisition recently, and as you know, the office space is very, very difficult right now, and it's something that's very highly, very large liquid name that really probably cannot get squeezed. There's not enough short interest in there to squeeze, really. That's one idea that we have that we've been short all year. Another name that we've been short recently that I believe reports at some point is e.l.f. They are a cosmetic company trading at 10 times price to sales. If your viewers are looking at shorts, I will tell you from years and years of experience, these high price to sales stocks are like shooting fish in a barrel from time to time. You've got to wait for the momentum to die down, but how can a stock fall from saying 100? Like, for instance, we shorted Carvana years ago during that craze, and it was starting to break down. But when you get these stocks that are 10, 15 times price to sales, and they start missing their earnings growth, and they start, they're still doing okay, but a traditional GARP player isn't going to pay anything over 3 to 4 times price to sales. So when you see a stock starting to stumble at above 10 times price to sales, that's when a stock can really fall 30 to 50%. And so that really attracts us, and e.l.f. certainly fits that mold. We saw Ulta miss just recently. We feel like the area is very competitive, and we just think that e.l.f. has really distributed into the channel as aggressively as they can. So we think that their growth rates are going to start coming under pressure.
One of the names I understand you might be shorting is Diageo, which over the years, or many years ago, I made some money in. What don't you like about Diageo right now? It's certainly underperformed like a Constellation Brands. The company has misstepped a number of times, but look where it is relative to where it was, and also it's so grossly underperformed Constellation Brands.
I don't disagree with what you're saying. However, the fact is this is a classic roll-up. They were buying up tons of brands along the way, rolling them into their platform like mini roll-ups, and then taking those acquisitions and getting them better distribution. The problem is they paid way too much for a lot of different acquisitions, and now the market's moving away. You've got the weight craze going with all the shots with Lilly and Ozempic and stuff, and the result from that is less drinking. People are also moving to marijuana drinks, which just came out in the last, say, year, that are really have incredible growth rates. You have marijuana that is getting completely legalized in all these different states. And so you really have a lot of competition that they've never had before. And of course, like I said, they were overpaying for a lot of these brands where they felt like their growth rates would continue. Now it's moving the other way.
Before I let you go, you mentioned back in the day you were short Carvana. Would you short it again, given the momentum and the short position now? It's 26% shares short.
Not right now. We do hate the default rates on ABS debt is really starting to rise. I believe it's up to 8 or 10% of the entire outstanding tranche of ABS debt, which is the type of debt that that is involved with borrowing. We like CarMax as our short in that space, and the reason we like it is because they've got over 16. So a lot of companies syndicate their debt, so they'll write up a loan and then they'll sell it out. CarMax actually keeps a lot of their own debt, and so if there are some losses that are coming, they are going to have to write those down. And while we think that CarMax is operating well, we just think in general they're in a very tough environment with a lot of debt that's going to have to be written down at some point.